The date is the 10th of October. Donald Trump announces a 100% extra tariff on China, and in the blink of an eye, the crypto market plummets. Within a few hours, $19 billion are wiped out. The crypto market cap drops from $4 trillion to $3.5 trillion. The crash is so big that it becomes the biggest single-day crash in crypto history, 10 to 20 times larger than the 2022 FTX collapse and the COVID crash. More than 1.6 million traders who have invested their entire capital solely in crypto are affected, and they go bankrupt. The body of a famous trader, Konstantin Gallik, is found in his Lamborghini. In the crash of 10th the 11th of October, Bitcoin falls by more than 14% to $104,000. A drop of more than 12% is recorded in Ethereum. 97% of altcoins are the most severely affected. Altcoins like Solana, Cardano, and Avalanche plummet by 40 to 70%. A meeting between Donald Trump and Xi Jinping takes place in October. Another major fall is seen when the federal bank cuts its interest rates by 25 basis points. The crypto market sees a significant drop. Within 24 hours, the crypto market cap drops by 3% to $368,000 crore. Once again, investors lost 28 trillion rupees in only 24 hours. Similarly, on the 5th of November, the price of Bitcoin drops to $99,000, its lowest level since June. On this day, traders lose around $2 billion. It had already dropped more than 20% from its record high of $126,000 at the beginning of October. No matter how much crypto supporters claim it's just a market correction, the reality is that the crypto market has severe flaws, in which the average trader merely becomes a pawn. Only the big players benefit. So, what is Bitcoin? What is the full story behind these successive crashes? Who are these big players? And how are they exploiting loopholes in the crypto infrastructure to make billions of dollars? In this episode, I will explain. Crypto is a market that once made some people millionaires and billionaires, and the middle class started dreaming big. But you will be surprised to know about the devastation it has caused in the last month. More than 2 million investors have gone bankrupt. Major billionaires who had invested in crypto are being found dead under suspicious circumstances. The crash on the 10th of October became the biggest one-day crypto crash in history, and Donald Trump was said to be behind it. This crash was so severe that altcoins, including Bitcoin and Ethereum, have not yet recovered. Since the crash, the positions of more than 2 million traders have been liquidated. Bitcoin, which reached its all-time high of 126,000 in October, is now struggling around the 100,000 mark. So, is the crypto market safe for ordinary investors or not? Whether they should invest or not is the big question, because the crash on the 10th of October is actually exposing the fundamental flaws of the crypto market. The crash shows that the trading rules here are made in favor of the big players, and an ordinary investor is easily duped. President Trump, who was a staunch opponent of crypto during his first term, has now become a staunch supporter of it. Binance founder CZ, that is, Changpeng Zhao, who was sentenced to 4 months in prison, was pardoned by Donald Trump. CZ confessed. Binance too. The investigation revealed that Binance had helped users evade US sanctions through its platform. For this, the court had imposed a fine of about 33,000 crore rupees on Binance, but Trump got him out of jail, especially when Trump and his family were themselves increasing their investment in crypto. Trump had launched his own currency. His company, World Liberty Financial, raised approximately $550 million through token sales. And in just 6 months, the Trump family made $800 million from crypto. Coincidentally, the biggest crash in history occurs on the 10th of October, and the very next day, Trump's son buys a $500 million yacht. Meaning, money from all over the world is lost, but the Trump family's is not. The biggest flaw in the crypto industry is that it has become like a casino, where both large and small investors are encouraged to take out loans to place bets. This process is called leverage trading. In this, investors are allowed to place bets much larger than their actual capital. When the investor wins the bet, they pay interest to the lender and keep the remaining amount for themselves. But if the bet goes wrong, they have to pay back the loss amount. This method is considered risky even in the stock market, but in the crypto market, the level of leverage is many times higher. Here, traders talk about placing bets up to 10, 40, or even 100 times their actual capital. Many platforms themselves encourage users to borrow and trade. By July 2025, loans worth $53 billion had been given for this type of leveraged crypto trading, and on the 10th of October, when the crash happened, this amount was even higher, meaning as soon as the bubble burst, leveraged investors not only lost their capital, but also had to face the double whammy of repaying the debt. The second biggest flaw of crypto is the platform's liquid staking system, which multiplies the leverage risk many times over. Actually, crypto platforms offer investors the facility to stake their coins. What happens when you stake is that your coin gets locked, and in return, you receive a token. Now you can pledge this token to get a loan from the platform, and with that loan money, you can once again invest money in the market. Meaning, the platform gives you the opportunity to invest the same money multiple times, in exchange for which it takes 12 to 15% interest. But this is where people get trapped. Because this way, the risk increase is manifold, because when the market crashes, the value of these double-counted collateral coins is the first to evaporate. This is what happened on the 10th of October. The investors who had made such trades had to suffer losses greater than their debt, because although their token existed on paper, in reality, it had no value left. The third major flaw of crypto is that in the stock or commodity market, there is a fixed time period for trading. They open in the morning and close in the evening. But the crypto market remains open 24/7. In such a situation, when panic spreads, there is no cooling off period to curb the decline. This is why this continuous trading model not only inflates bubbles, but also makes downturns more devastating and dreadful. Now let's talk about perpetual futures trading. This is the biggest flaw that has made the crypto market unstable. Perpetual futures trading is quite different from traditional futures trading. In a traditional futures contract, two traders bet on the future value of an asset like gold or wheat. These contracts have a fixed expiry date. For example, delivery or settlement will be made after 9 months. As soon as the time is up, both traders have to close the trade. But perpetual futures are a different matter. There is no time limit here. A trader can keep their position open for an unlimited time, meaning keep playing as long as you want. If the market is fluctuating, change the terms accordingly, place a bet, and invest again. This is where the real danger begins, because people keep placing new bets on their old terms. Speculation in the market increases on those same terms, and asset prices start to inflate artificially, meaning they rise far above their real value. Some investors find these perpetuals very glamorous. They think money can be made from every fluctuation, but the reality is that it makes the market more unstable and risky. In short, perpetual trading has turned crypto into more of a gambling arena than an investment, where new bets are placed every second, but the house, meaning the platform where the money is being invested, always wins. So, crypto's most dangerous system is also automatic deleveraging, the effect of which was seen to be terrible in this crash. Automatic deleveraging is a system in which the platform sells investors' positions itself without asking. You won't believe it, but this happens so that the platform can recover its losses. In fact, crypto platforms lend money to those investors who do leveraged trading, meaning they take a loan to place a leveraged bet. But when the market suddenly falls, the value of the portfolios of traders who have bet on credit decreases rapidly. In such cases, the platforms forcibly sell their coins or assets to recover their loan amount. This is called liquidation. Many platforms also have insurance funds to deal with such risks, but when there is a simultaneous sharp fall in the market, even those funds are of no use. In such situations, platforms adopt automatic deleveraging, through which the system automatically starts closing the positions of those investors who are still in profit. It sounds strange, but this is the reality. When the market crashes, platforms first sell the assets of the losing investors, and if the platform's loss is still not covered, a portion of the profits is forcibly sold and recovered from the traders who have made a profit. Due to this process, in the 10th of October crash, the positions of thousands of traders were automatically eliminated through deleveraging. And this very loophole often opens the way for market manipulation in this game. Large investors, who are called whales in crypto language, always win the bet, whereas small investors, jokingly called shrimp, repeatedly suffer losses. This is what happened in the recent crash. Just a few hours before Trump's tariff announcement, several large investors placed heavy bets that crypto prices would fall. And as soon as Trump made the announcement, the market crashed. To accelerate the fall, some unknown traders deliberately sold a large quantity of tokens, those tokens which were most used for leverage trading. This massive sell-off confused Binance's pricing Oracle software, causing the Oracle to suddenly value those tokens extremely low, which sent the entire market crashing down even faster. This further widened the difference between the actual price of crypto and the short bets placed on them, and later, those investors who had already taken short positions profited by approximately 13 billion rupees from this fall. Many experts believe that this was no coincidence. It's possible that these large traders had insider information, based on which they had already devised this strategy and bought the yacht. The problem with crypto is that it lacks a unified value system that would allow a coin's value to appear the same on every platform. Prices appear different on every platform, and whale investors take advantage of these differences to carry out price manipulation. Oracle manipulation is very common in this market, whereas in the traditional stock market, it is mandatory for every investor to see the same and transparent value for every asset. There is no such rule in the crypto market. Another problem is that most traders in the crypto market operate with wallets having fake or anonymous IDs. In such a scenario, it is almost impossible to find out who is investing how much or who can exert how much influence on the market. This is where hidden whales create artificial fluctuations in the market, manipulate the value of crypto up and down as they wish, and walk away with profits, while the ordinary investor remains trapped in losses. What are your thoughts on this report? Be sure to let us know in the comments section.